Welcome to part 2 of the Islamorada Investment Management Annual Investor Meeting. Thanks for the patience, and please excuse my delay in getting this one out. The tough thing about putting a coherent slideshow together about the TARP portfolio in the year 2020 is how much happened. It was a lot. So my approach here is going to be this. I'm going to do a high-level review of what happened in 2020 and the actions we took in Tarpon, refresh a little on what we're doing here in the big picture sense. We'll talk a little bit more about my expectations for 2021, and then we'll go over some recent questions I've gotten after that. Before I go too much further though, the perfunctory disclaimer slide. Okay, let's get into it. Wanted to start by reviewing the underlying philosophy behind how I really allocate our capital in this portfolio. Several years back, I think it was after an 82-page investor letter to you all, I made the choice to really reshape Tarpon and focus exclusively on the energy sector. It was mostly on U.S. oil producers over that time. E&Ps, they're called. But beginning in 2020, that was increasingly on natural gas companies too. That approach was driven by what I still believe is a rare opportunity, even if it feels like it's taking forever to realize. That approach has also had a price for sure. As per the first few months in this chart right here, and that price has been volatility. So this is the chart of our performance from the beginning of 2020 through the end of January 2021, which was yesterday. So I've included that here as well. For calendar year 2020, Tarpon was up 10.3% after fees, though on an unaudited basis. And we had a good January of 2021 too. So while it is true that Tarpon ended 2020 10% higher than it began, that also really doesn't do justice to a whole lot of drama in between the first and last days of that year either. For all the daily details and the play-by-play of 2020 and what I did, I'd refer you to the investor message boards. But that big dip early in 2020 there, that was the third and by far the most unpleasant geopolitical curveball we've seen related to the energy markets over the last few years. It's my fault, obviously. I did not see a Saudi-Russia oil price war during a once-in-a-century global pandemic coming at us this time a year ago. And look, my apologies for all the stress that may have caused you. I get how the first quarter of that sort of chart can really cook your grits, but as that spring collapse was happening, odds were also pretty high that it was only going to be temporary. It was hard to define at the time how long temporary would be. But back in February, March, the most near-term risk the market was focused on was a sudden collapse in the use of oil and natural gas due to the novel coronavirus. That wasn't the biggest real risk to me, though. The bigger risk was looming a bit further off in the background, and that was really the second-order impact of coronavirus and how it was going to exacerbate the crisis investment, the crisis in capital expenditures we were already seeing in the industry before COVID hit. The industry had already dialed way back on making investments in oil supply prior to last February, and then COVID came in and shut the door on those capital expenditures for 2020, which does increase the odds of shortages and price shocks eventually. So we took some heavy blows last February, March, as per this chart, and realized some significant losses in some of the names we owned at the time. There was nowhere to hide, but we did have a chance to high grade some names in our portfolio. So I took it. I ate those losses and then expanded our companies in Tarpon to also include natural gas and NGL, natural gas liquid companies too, both of which may end up being some of the biggest indirect beneficiaries of the slowing of growth in U.S. shale oil production. And I say that because nat gas production in the U.S. had really started to hit the brakes in November of 2019, because a lot of natural gas produced in this country is almost an afterthought. In Texas, it's almost just like the other stuff that comes out when you're drilling oil wells. But that oil market shock of early 2020 there, it only made the eventual rebound in natural gas prices that much more likely too. So while I'm not as big a bull about nat gas prices as I am about oil prices, they were also just too low last February, March. After the changes we made last spring, and again, I defer you to the IIM message boards for the play-by-play, but after those were complete, I felt like we did get some good confirmation from the market that we were thinking about things the right way. Later in the year, we saw both Montage Resources and a little bit more recently, QEP Resources get acquired. Neither one of those positions in Tarpon saw much in the way of immediate gains the day those deals were announced, but it was good confirmation in any case, I felt. I was also happy to say that we locked in a 54% annual yield, as in 54%, by buying Altus Midstream in the chaos of last spring, when the market had really almost given up on the company's dead. But then the company announced it was starting a big and sustainable dividend in November. So Altus was also a nice little surprise in a year that started out with a lot of unpleasant ones. To date, our best performers in Tarpon are our largest position in Antero Resources, where our cost basis is $1.81. We are up 529% there through last Friday, the last trading day of January. And that is second only to Matador Resources, which is up 744% since we bought it during all the chaos last spring. I should tell you, I have no intention of trimming or rebalancing either position here. That would be directly contrary to what we're trying to do, as I will get into a little bit more on a later example involving Antero. So now, a year after COVID first came to the U.S., it appears the world is set to be short of oil much sooner than it no longer needs oil. COVID has ratcheted up an investment crisis in the oil and gas industry that already existed before this pandemic and which is now unprecedented. That's actually not my phrase. Those are not my words there in the bottom. That's from a study done by Boston Consulting Group and the International Energy Forum a month ago. By investment, I mean here the capital expenditures that the industry needs to do every year to maintain and grow the supply of oil in the world. That investment is now effectively dead, though, at least on a relative basis. It was whimpering along a year ago, and then COVID came. As a reminder, due to the decline curve, the world has to replace almost all of today's current oil production by the year 2030 just to hold production levels still. If the world is unsuccessful in replacing that production, then the price of oil will rise until it reaches the point where it has incentivized the capital expenditures that'll be needed to create the supply that is in turn needed to meet global demand. That's not a prediction, mind you. It's really just how markets work. At the same time, there seem to be, large portions of Western civilization that are going energy blind. Plastics, pharmaceuticals, fertilizer, lubricants, polyester. It all starts with crude oil. Crude is in everything, yet if you read a lot of headlines these days, it's as if most people have no idea. Before COVID hit, the world was consuming a record number of barrels of oil every day. 100 million barrels every day. Again, 100 million barrels of oil every day. That's the highest in history. It's the most traded commodity in the world. The market collapsed after COVID. A few months back, demand was still estimated to be at 93 million barrels a day. And that, as it turns out, ends up being about 1,000 barrels a second of oil being used around the world, even not too long after COVID hit. Now, electric vehicles will come eventually, and though personally I could get kind of excited about one day driving an electric pickup truck around the Keys, but my point is it's going to be a long, slow process to get there. I'll have a little bit more on this later. For now, though, I just sort of can't help but note the irony that so many headlines and pundits and politicos and investment committees around the world are abandoning oil and natural gas really at the exact same time that the facts would suggest that the stage is being set for an energy crisis, potentially, that would result in windfall profits for those same companies while they are at historically depressed valuations. This sort of thing seems reasonably predictable and frankly somewhat obvious to me. And while I'm still a bit curious why it's not showing up more in mainstream news headlines, I guess there is some consolation in that it is starting to get acknowledged a little bit more frequently in the industry and on the street. If 2020 was the year of the super spreader, then perhaps 2021 will be the year of the super cycle for oil. We shall see. Let me step back a bit and talk a little about portfolio management in general. Last spring was a real gut check, and I want to sort of acknowledge and frame that a little bit here. Everything I do with our money, the entire process of managing it all the time, not just last year, is really based on trying to solve for a big paradox. That paradox is that to have a differentiated, successful investment strategy requires a serious commitment, but that commitment needs to be made and kept in a deeply unpredictable world. So how do we resolve that? Well, I think it starts by answering three fundamental questions. How should we manage this uncertainty? What portfolio should we choose to have? And how should we allocate capital in that portfolio? And I mention this because, in 2020, the world faced some pretty profound uncertainty, including around some real fundamental variables for the entire energy industry. Those uncertainties influence the outlook for people and companies and governments across the world. And at times it was enough to, make you want to just go sit on the couch and sort of slip into Netflix oblivion all day. But, when it comes to investing, that's the one reaction we've got to avoid, right? Like it or not, we've got to learn to live with that uncertainty and keep grinding away. Just keep looking for insight in all that noise. One big way we do that here is by taking in a lot of independent proprietary research on the macro level when it comes to oil and natural gas to inform the decisions we make at the company level in the TARP portfolio. In energy, there are so many big questions and literally thousands of scenarios that could show up depending on how I answer those questions. Like for instance, the degree of penetration of electric vehicles by 2050, say, which will eventually have a profound impact on the demand for oil down the road. And while I may not have time to go figure that answer out myself, other experts do. So, okay, let's see what they have to say, pay up, read up, and then try to think it all through. Because all those details can absolutely matter. The point is that there is a wide range of future possible outcomes, a wide range of future worlds that we could be investing in. So, what do we do with that? What do we do with those outcomes? The good news, in my mind, is that the answers to those big three questions held up last year. That strategy, sort of encapsulated by those answers, passed the stress test. And across all the possible future scenarios, I think these answers work too. First, how should we manage that uncertainty? Well, let's focus on strong balance sheets, low break-even prices, retain exposure to upside in prices, and proactively manage the risks around a new U.S. administration and whatever its policies around climate change could be, for instance. Second, what portfolio should we choose? Well, the one that can safely capture the most long-term free cash flow per share at the lowest possible price. And then finally, how should we allocate capital? Well, you can see it right there. To management teams we trust and which also share a relentless focus on returns and generating free cash flow. One of the silver linings of negative oil prices last spring was that it pretty quickly confirmed and in some cases exposed some of my own beliefs about a few of our management teams. And look, to be clear, it also exposed some of my own mistakes and assumptions that went sideways on us when we were exposed to the real live extreme tale of a probability distribution we were in there. We were able to adjust pretty quickly, though, and we came out of it having allocated our capital really in two buckets inside Tarpon. One of those buckets was of oil companies and now some natural gas companies too, where I felt like we had a high degree of visibility and could predict things with a pretty high degree of confidence. And then we came out of there with a smaller bucket of companies that had less near-term visibility, although still not much real risk, and which were even more asymmetric opportunities. They had several options, for instance, when it came to the ways that that value might be realized. So last February, March, we could buy well-run energy companies with moats around those businesses, trading below PDP value and or with significant free cash flow yields that should benefit immediately from a rebound in oil and natural gas prices. And we could buy a few others that, though would take a bit longer to play out, should still compensate us well for waiting. We had what I felt was a margin of safety in terms of commodity prices, at least. Oil prices were negative after all, which is just kind of silly, and natural gas prices were also unsustainably low. We were at the bottom of the cycle finally, and even other value investors have been still, I think, too slow to acknowledge that certain capital-intensive businesses that create high returns on invested capital can actually be tremendous value creators too. So we've come a long way in a year. We still have a ways to go, though. We had a few lousy years prior to last spring where the S&P 500 index trounced us as energy sort of struggled to get off the mat. But I do hope you've seen enough of a glimpse of the future here lately that it gives you even more patience to wait for those really interesting months and quarters and years, which are still ahead of us. The good news here is that the heavy lifting is behind us finally, and know that whatever else might surprise us down the road, our strategy, our little approach here can handle it. At the moment, we have some cash in Tarpon, and while I likely will put that to work for us before too long, I otherwise anticipate a whole lot less trading this year. So here are a couple of reasons I think it's different this year in terms of finally being on a sustainable path to higher oil prices, and why I anticipate hopefully sitting still when it comes to Tarpon for the foreseeable future. OPEC is pursuing a new tactic in its strategy to support the oil market by targeting what is called backwardation. Briefly put, OPEC is focused not only on today's oil inventory's impact on prices, but future prices as well, in the shape of the oil curve. OPEC is explicitly pushing the market into backwardation, which is where the future price of oil is lower than the cash price of buying a barrel today. This whole approach, it's similar to how central bankers of late have started to focus on the interplay between long and short-term interest rates. If oil is in backwardation, that encourages traders and refiners to take oil out of inventories because the cost to store it are higher than the profit generated to trade it, and that drains the oil glut, and that makes it harder to hedge future production, which in turn should cap excess activity in U.S. shale and other longer-term projects too, all of which will eventually lead to higher oil revenues for OPEC through both higher oil prices and higher market share as well. Backwardation also incentivizes speculative traders and their algorithms to purchase crude contracts due to the positive roll yield that backwardation creates. In any case, the point is it's the right strategy to sustainably boost oil prices. And it's notable that OPEC is finally succeeding in executing on it at the moment. Because of CapEx cuts by operators and the inability of suppliers to lower their prices, industry CapEx in 2020 fell to levels last seen in 2004. When prices were similar to today's. That combination of low capex and low prices back in 2004 contributed to the subsequent historic high water mark for oil prices in August 2008, as rapid growth in Asia unexpectedly boosted demand. I don't know that it's going to be exact mirror this time. There are reasons to think it may not. But the point is, even before COVID, the seeds were sown for a significant slowdown in production growth from U.S. shale in particular. Now, after COVID, we are looking at a massive and at this point unavoidable structural loss in U.S. shale supply growth. And to put it bluntly, a massive underinvestment in the supply of oil will absolutely have consequences on the price of oil at some point. Those consequences will be intractable unless spending is increased. yet it's a little chicken egg, right? Spending won't increase unless oil prices are high enough to incentivize that. That problem of underinvestment, it also compounds over time. Because the industry has removed a significant chunk of costs from upstream since the price downturn of 2014, twice as much production is available now in the world at $50 a barrel as there was prior to this whole downturn. So that goes the other way too, meaning every dollar of 2020 and 2021 capex that is cut will have twice the impact in reducing activity that cuts made after the 2014 price fall had. So, big picture, in an industry as capital intensive as energy is, you just can't cut investment to that degree in a supply chain that delivers such a critical global energy source that, by the way, has no immediate material substitutes. That is a textbook recipe for, among other things, significantly higher oil prices. Yet, that's what we're doing. That's what we've done. So if you couple the bounce back in demand we should see for oil after COVID is under control with that lack of critical investment, along with what is really a widespread misunderstanding about the degree and speed with which renewable energy can actually replace oil and natural gas, then another bull cycle in energy seems inevitable, at least to me. And then if you also presume that we're going to see the biggest ever annual jump in global GDP growth in 2021, as the world comes out of this coronavirus lockdown, then the odds seem that much higher that we are now at the start of a bull run in energy, finally. The day we hit negative oil prices last spring was also, not coincidentally, the day that the entire U.S. shale industry was forced to finally live within cash flow. The high growth days of production growth financed by a lot of stock and bond sales were finally over. Which means, among other things, that oil prices will move higher over time and that the companies that could fund their own growth through internal cash flows would finally be able to begin accruing long-term value for their shareholders. The impact of last spring's chaos on U.S. shale in particular was huge. And while that shock had a lot of ripples across everything from industry capex, like we talked about, to M&A, to corporate governance, to shale productivity, to accelerating the adoption of free cash flow as the dominant valuation model for shale companies, the ultimate impact is going to be on shale's contribution to the global oil supply. I want to give this a little context here because too many folks don't quite understand how much the new technology that is U.S. shale, how much unconventional U.S. oil production really changed the calculus of the oil markets over the last 10 years or so. So just consider that from 2012 to 2019, global oil demand increased over 9.6 million barrels of oil per day. Over that same time frame, U.S. production of oil and liquids increased 8.3 million barrels of oil per day, meaning that U.S. shale accounted for just under 90% of global demand growth over those years. So, to reiterate, about 9 out of every 10 barrels of oil that the world's economies needed to grow over the past decade came from the US of A. And then to put that 8.3 million barrels of oil a day of growth from shale into a little more perspective. At the beginning of that same period just mentioned there, in 2012, Saudi oil production was 9.5 million barrels of oil per day. So, in a sense, over those next 7 years, you could say that U.S. shale essentially replicated 87% of a whole nother Saudi Arabia. Which, among other things, that's actually pretty amazing. In my mind, U.S. shale represents probably one of the greatest technological breakthroughs of our lifetimes. And that's, before you even start to imagine what the world and the global economy would have looked like without that high level of growth out of shale from the U.S. over the last decade. Only now, we don't have to imagine because we are going to find out. I think this slide kind of speaks for itself. Compared to the Dow, all commodities, including oil and natural gas, are currently valued right around a 100-year low. So let your imagination run free there. This year, I think the price that we're going to pay isn't going to be volatility, but probably boredom. At least I hope it is. As we kind of sit still and wait for things to continue to play out, now that we're finally through the worst of this particular oil cycle. There's a lot of times last year I could practically hear the scoffing. You all almost certainly know someone that has probably made a lot of money on something like Tesla or Bitcoin or GameStop this month, which seems a whole lot easier than this energy stuff for sure. But I would also ask you to remember two things, really. The first is that in investing, the lowest average cost basis wins. And the second is that, analytically speaking, history has shown that low expectations have been more important than high growth when investing over a long enough period of time. Okay, let me try to show you what all that means for Tarpon. Here is the actual cost basis data for one of our positions, our largest, Antero Resources. And to be clear, this is not predictive as much as it is illustrative about the power of compounding. So our cost basis in Antero is $1.31. Let's say that by year 3 of owning it, shares are then worth $10 each. We then have a nice little 663% gain. 1 year later, price goes from $10 a share to $12 a share. And someone who bought Antero Resources shares at 10 in year 3 will, at the end of year 4, have earned a 20% gain. Because of our cost basis, though, our gain over that same incremental year will have increased another 153%. Now let's also say, we'll fast forward a little bit just to drive this point home. Let's say in year 7, Antero's trading at $20 a share. That buyer, the one who bought in year 3 at $10 a share, will, by year 7, have doubled his money. He will have returned 100% when the price of those shares goes from 10 to 20. But our gain will have increased an additional 764% over that same period. The point of all this is, and hopefully this is clear, that when you're investing, the lowest average cost wins. Also means that waiting until the coast is clear before you invest, it's just a recipe for mediocre returns and can come with huge opportunity costs. Buying extremely undervalued shares can be so worth it. It can be so worth the stress to do that we got to be willing to tolerate not only that extreme volatility, but we got to be able to step up and buy even when we're right in the teeth of it, just because of the math of compounding. So the point is, this slide is the whole point. And if you assume that we are through the worst part of the cycle, and or that we won't ever see cost bases that low again, like I do, then you can take that same idea and apply it to the rest of the names in our portfolio, and maybe it gives you a little better sense of why I think this will be worth it down the road a bit further once we have the time to let the compounding kick in. I do have a table that does just that. You can adjust those prospective gains over time on our actual cost bases by the current market weightings in the portfolio, and then using the old sum product command in Excel, you can determine the expected return for the entire portfolio. But no, you can't see it, not yet anyways. You'll think I'm insane or that the spreadsheet is broken. And frankly, my concern would be that you all will get your expectations set too high. So let's just agree that compounding can be magic, and that we'll sort of take it all step by step here a bit longer, if we could. When it comes to my expectations for 2021, I think it's probably safe to say that things will get crazier than we expect at some point. After the last few years, that just seems like probably a good blanket assumption to start with. A little more specifically, when it comes to coronavirus, which I talked a lot about in part one of this little mini-series, potential silver lining, the recent rapid increase in new cases, at least here in the U.S., it looks like it may be stalling out. The curve is flattening, but short version, it's hard to tell or read too much into that at the moment, so just stay tuned. Related, the vaccine rollout has been slower than expected, but I still expect a very strong travel season coming up in the summer of 2021 here, and as such, we should see a significant boost in oil demand starting at the end of Q2 of this year. There are also just not enough drilling rigs and or fracking crews at the moment to keep production flat from where it ended 2020. Total drilling rigs in the U.S., both oil and natural gas, fell 75% at one point in late 2020. And again, to reiterate, we just don't have enough completion crews working, enough fracking crews working to keep oil and gas production this year flat with where we ended last year. And it's not close. So as U.S. production growth stalls out, that will be supportive for oil prices and companies like ours. I also expect, Q4 reporting season in February, March is not that too far away. And my expectation is that we'll hear a lot of commentary from companies on those Q4 calls that underscore no to very low growth in the U.S. production anytime soon. In terms of specifics, global barrel counting just went out the window last year. Way too many variables, way too much uncertainty to be confident in that sort of approach, at least in my mind. But on balance, a base case of $55 WTI seems reasonable this summer. Then 60 by the end of this year, and then call it low 70s the end of next year. That sort of stair step seems rational. Although, there is upside risk to that over the same time period. And look, there's downside risk to it also if COVID is more stubborn than expected. Also would note that, the odds of an eventual price spike during or beyond that window, it also increases more every day that CapEx suffers. But I do expect we'll be below the 5-year average when it comes to U.S. oil inventories. We should be below that 5-year average this summer, and the global oil market will be balanced by then too. I also expect Iranian barrels to be allowed to re-enter the global market at some point later this year. Otherwise, that $60 bogey I have there for the end of this year would likely be higher. Related, I expect nat gas prices will average $3 this year. That strip for nat gas is, frankly, it's currently weaker than it should be right now. Nat gas production in the U.S. is down from year ago levels and sort of continues to ebb. And production should fall further in the first quarter here as less ethane rejection occurs due to higher prices and demand for ethane in that stream. Finally, related to our company specifically, I expect in 2021 for free cash flow per share growth to continue. Cash generation will increase. Returns to us should increase, whether that's in the form of debt paydowns or dividends or buybacks. Revenues and margins should increase. We should see some revenue growth and margin expansion across the board. Multiple expansion, though, for our name still seems a bit fuzzy. To me, it's coming, I suspect, just a bit further out. In my mind, likely we'll have to see WTI north of $60 a share and sustainably for the market to really start explicitly assigning higher multiples to our companies here. Okay, we're going to shift gears, talk through some FAQs. The first question I've gotten lately is about the new administration. I have a new president. We have a new White House. A lot of discussion on the investor boards lately on this, but the short version is just to remind you that anything that the Biden administration does that restricts the supply of oil and gas will be bullish for commodity prices. The executive orders that the White House has announced so far had been being telegraphed, I should say, for a long time. They were of little consequence to our companies. I also expect in the near term some air and water quality regulation rollbacks, but that shouldn't have much impact on our companies either, because they were already in compliance with tighter regulations from the Obama era. And it's also best to expect some other moves via executive order and ostensibly legislation too for policies that are call them renewable supportive. Though the White House will invest or incent a lot of money to be invested in renewable energy, it's going to take a long time before renewables really become a true risk to oil and especially nat gas, as I'll get into more in a minute. So to sum up, have eyes on a handful of different things, but in the end, I suspect that the worst fears and then some about a new administration were really already baked into the share prices when we did most of our buying last spring. Whatever happens in a new administration when it comes to oil and gas companies would have to be both completely unexpected and dire for me to consider giving up those cost bases we have in those companies in Tarban right now, for sure. What about EVs? What about electric vehicles and renewables? Another question I seem to be getting a lot lately. Let me start. Here's what I like about alternative energy. The industry, it's still in its infancy. There's plenty of room for growth. Most investors see it as sort of clean and socially moral. It's not controlled by a cartel. It's just driven less by geopolitics and a whole lot more by innovation and technology, which is really what I feel like these next few decades in energy should really be all about. That said, let me be clear. The stocks of EV and renewable companies right now are currently in a bubble. Valuations are just way, way, way out of whack with their fundamentals and reality. On renewables in general, the capital needed for the energy transition, the money that'll be needed to transition the globe completely off fossil fuels, it is stunning. Generally speaking, it takes about $100 billion to build out renewables capacity equal to 1 million barrels of oil equivalent per day. And again, the world consumed 100 million barrels of oil per day before COVID. So you can do the math. That is a lot of zeros in terms of cost. And meanwhile, the oil and gas industry can provide that same daily capacity for 30% of that cost, and then even lower in the Mideast. The point is, those economics are going to be hard to beat for some time still. On EVs specifically, electric vehicles specifically, know that 2/3 of oil demand comes from transportation, and about 40% of that comes from cars. And despite high growth rates in EV sales, in percentage terms, mind you, before COVID, the actual number of electrical vehicles sold in 2019 was less than 2% of all new car sales, and less than 0.25%. I'll say that again, less than 0.25% of the total global auto fleet. The number of EVs on the road today displaces less than 0.1% of total global oil demand. On Tesla specifically, in 2020, I think it's of note that Tesla delivered just about 500,000 cars for the year, but it added almost $750 billion, $750 billion with a B, to its market value. The stock market is actually now valuing Tesla as more valuable than Exxon, Chevron, Shell, Total, and BP combined. That broader bubble, it's fueled by a number of things, including a lot of excitement and unrealistic forecasts about growth and adoption rates. And while it is true that the new U.S. administration probably will attempt to spur that growth through various policy actions, it's still going to take a very long time for those to displace a meaningful amount of oil demand. Right now in America, there are 270 million cars on the road in America. About 1 million of them are EVs. Most Americans cannot afford a Tesla, and there are no other major EV brands widely available yet. So I feel like a little skepticism is warranted when it comes to whether or not there's any kind of government plan that can address all of those significant hurdles in the near term, at least. It's kind of the inverse of where the market was a year ago. At the bottom, everything is awful and investors are staring at the 6 inches right in front of them. And then at the top, like we are in this EV and renewables bubble, at the top of that bubble, everything is awesome. And investors extrapolate all positive news forever to infinity. In any case, we are very, very early in the global energy transition still from oil and gas and coal to renewables. There are going to be excellent investment opportunities along the way. There are not too many at the moment, in my opinion. So given all that, perhaps one way to think about Tarpon is as a hedge if renewables are in fact being overhyped. Or, on the other hand, if you're truly bullish on electric vehicles, but are in any way skeptical about some of these valuations, I'd suggest that perhaps the natural gas producers that power the generation facilities that produce the electricity that will charge up those Teslas, perhaps that might be a less risky way, to participate in the growth of EVs. And the final question that I seem to get: can we really catch up to the broader market? And the short version is yes, that's the plan, but we're going to have to stay patient. And please understand, my plan to do that is to sit still and let the compounding kick in. I am not trying to trade our way to victory here and trying to close that gap that developed the last few years between the chart of Tarpon's performance and the chart of the S&P 500. Let me step back a bit. Compounding money at high rates over an extended period of time, say over years, let alone decades, it is extremely hard. But the approach to that I think most of you are most often exposed to outside of here, is an approach that basically says, let's go find a stock that will double, and then once it does, we can sell it, and then go find another stock that will double, and then another, over and over again, until one day you've amassed a great fortune. The thing is, though, that is close to impossible for almost everyone. To do that, you've got to have supernatural levels of insight and judgment about a huge number of industries and companies built up over a long period of time. You've got to be flawless on timing your buying and your selling, and that implies you've got to be smarter than everybody else on the street. Plus, these days, a few data centers worth of computer processing power. Probabilistically speaking, to figure out how successful that approach of finding new stocks every calendar year that double, to find how successful that approach would be for you, you need to multiply the probability of getting each one of those judgments and decisions and timing windows correct all together each time. And if you do that, you'd find that the probability of you succeeding overall that way is extremely low. The point is that you're just much more likely to succeed in this game of investing by having a few, important insights about a small number of potentially huge winners, should you ever be so lucky to find them. And then, most importantly, assuming you have the gumption to buy them when the rest of the world hates them, you need to stay out of your own way and let that compounding magic work by not selling them. The good news is that the problem of our underperformance the last few years should self-correct over the next few years, though again, it'll take some time. And I say that both for the oil market to normalize, and then because of how compounding in general will work in these companies as that happens. You may not notice it for a while, but then it gets real interesting fast. So we want Tarpon to keep increasing, obviously, but the other way to close that gap is for the broader market to slow down too, right? And that's where this little chart here comes in finally. Because most of the growth in the S&P 500 index over the last 5 to 6 years has come from 5 stocks, the FANG stocks. We really just need those 5 stocks to kind of slow their roll a bit in order to catch up to the broader market. They each appeared to pull forward a good chunk of their 2021 earnings a bit into 2020 last year during COVID. So valuations are a bit high at the moment on balance. And if you consider that 2 of them, Facebook and Google, both currently have a number of states and the federal government looking at various potential regulatory actions against them, well, that might be enough to deter a little bit of demand for those stocks, I suppose. The point being that, okay, well, yeah, you know what? I like our odds here. Well, let's just see what happens. Okay, that is it. Thanks for making it to the end. Any questions or comments, please reach out. Got a couple of new things coming down the pike before too long, including a new website for energy aficionados, and going to start putting out some more detailed reports on the companies that we own in Tarpon 2 this year, now that I think I'll have a little bit more time to do that sort of thing. Also, I do want to make a final plug for the IIM investor message boards. This energy thesis can get pretty wonky, and it can have a high degree of difficulty at times, but I'd like to think the posts on our boards can be useful in helping to manage the ups and downs along the way. So if you're not on the boards but would like to be, please shoot me an email and we'll get you set up. Okay, that's all for me. Thanks again, and good night.